Now, we'd like to move forward tonight, of course, by calling on our Chief Technical Analyst, Juanis Barredo, to give us his technical perspective on things. Juanis.
All right, good evening, everybody, and so nice to see you again. We will have to be able to look at the remainder of 2014 and try to see what sort of strategy we can try to be able to do with in spite of much of the weak volumes we've been seeing. Of course, we've seen a lot of consolidations also beginning recently. And let's try to be able to have a look at what presents things in the technical landscape so that we can be properly set up to be able to take of the opportunity for 2015. Well, as we switch over a little bit to the dark side, and let's have a look at the technical aspect that we've seen quite a bit of a weak start actually in the stock market when we entered the year. Last time we spoke with you, we've seen quite bearish sentiment during that time. We also looked into the prospect that a big rally was coming during that period, and we did see one. It actually even went a little higher than what my expectations was, but in terms of what we expected right after that, it seems to be quite in line. So let's see how much more of that we might have to be able to endure. So I entitled my report today, "The Uptrend Shows Weak Momentum," and that is the perspective that we've had as of this point, and we are going to have to be able to reckon with that, as consolidations may have to be able to keep prices ranged, and we're just going to be able to focus on allowing ourselves more range trading opportunities. Now, in terms of the overview, we'd like to be able to begin by understanding that global markets are still being quite mixed in most of what they've been showing. There have been pockets, well, actually more strengths actually than weakness in the overall perspective. And part of what we're going to have is we're going to be seeing a lot more rotational movements moving forward for the rest of the year. We also began with fears of interest rates stemming, and that's because everybody was talking about that they may start raising interest rates in the United States. We haven't seen that yet. In fact, as I will show you later, we still had a reduction in rates in Europe, and so that kind of poured a lot of cold water into that fact about rates rising on the global perspective. Adjustments into equities, currencies, and commodities will consequently come about because since a lot of the expectation forced our market to come down in the initial part of the year, now that interest rates were kind of subdued, then markets obviously rallied in consequence to that particular activity. So in the second half, I think there will, although we might be into a consolidation, I think the consolidation could be a little bit more wide-spaced, and that means more volatility will come along with that. And that should be able to present some interesting conditions for, of course, the short-term traders who do capitalize on the opportunity when prices do come back to major levels of support. So we will look at what we can do with that. Now, if you probably were glued to the television in the last few weeks and months, and all they talk about are all the little problems taking place in the rest of the world, and these particular pockets have riddled themselves all across the globe. We've had pressures from Russia, we had pressures from Ukraine, we had pressures from even the China, Philippines, and other Asian countries moving along with that. We had pressure also coming from Portugal when one of their banks also went through some liquidity concerns. We do have one coming up maybe in the next 1 or 2 days where Argentina's ability to be able to pay off its debts will also be coming under question. We've also had to be able to deal with a very quiet disease that seems to be floating, partly in Africa. Ebola problems are also starting to manifest, and it is actually spreading right now, and we don't know what many of these things can actually come out. So there are a lot of little critical aspects that are showing around the world, and has it phased markets in terms of what we've seen with prices? The picture of what I'm showing you there is the difference between emerging markets and the developed markets in terms of their totality return. If you notice that when we started off in the year, the spreads for that were not really very, very big yet, but it was showing that developed markets were taking in a bigger chunk of the money because, of course, a lot of people were seeing that a lot of pressures could come off the weakness that was taking off in China, and of course that many of the emerging markets had had a recent gush, and many of them were looking to be able to pull back. As a result, if you've seen that both markets actually showed continuing improvement, and we didn't really see too hefty of a pullback during that period that we last spoke with you back in February. And if you were to put that into proper context, just for year-to-date performance, if you were to look at the slide behind on the right side, you would see that the graph in red, which is the emerging market yield for the year, has actually already surpassed what developed markets have actually shown. So we've rallied, and not only rallied, but we've managed to be able to overcome much of the returns that the developed markets have shown earlier on. So that's a good point, because it shows that there is reboundability from our side, and the rebounds usually are very, very substantial. In terms of putting the Philippines in calibration with those particular performances, you would see that the green line on the top edge of the left chart that you see, you could clearly see that there is a very big difference between what the Philippines managed to achieve as compared to what developed markets and emerging markets have done in terms of their aggregation. And that big difference over there shows roughly almost a 16% performance as of when we started that in 2014, where emerging markets were doing something closer to, I think, about 8% and almost maybe 4% in terms of the other two. The chart on the right shows you that the Philippines remains the third market in terms of performance, next to Indonesia and India. India just came out very recently to be able to jump up with a very, very strong rally, and it actually managed to be able to take the first placer. When we last spoke, it was really only the Philippines and Indonesia that was showing activity, but most of the other indices at the time were actually showing negative returns. So you can see from the picture there on the right side, most of them have recovered, have already gone to positive territory, and right now it's only Japan that seems to be trailing behind. But Japan's index is still looking quite vibrant and will more likely continue, so we might be able to still see positive aspect turnover for that before the end of the year. So let's have a look at the biggest market in the world, and looking at the S&P 500. When we start looking at the pictures that I'm about to show you, it's in reference of how well does it sustain the ability to recognize continuing growth and to see if there are any potential threats that might surface from that market that may reverberate to ours. And if you look at this particular index, I see absolutely nothing wrong that into its uptrend. It seems to be quite secure for the S&P 500. The only thing is perhaps that it is slightly on the upper end of the range rather than in the lower end of that range, which means that it could very soon already show some overbought concerns and generate some corrective element, but all within the scope of that uptrend. So I'm not really too worried about the US. I think it's really still very, very strong, and I don't think that would be too much of a medium-term catalyst for a pullback in our market. I'm looking at support closer to 1944 in the S&P, and short-term resistance closer to 2,000, and the upper band of that channel is at 2,045. If you were to have a look at what the problems were that were being instigated in the beginning of the year, we were talking about interest rates, and many of us were talking about tapering. Tapering has already indeed had taken place, and quite a chunk of that bond buying has already been wound down. And if you look at the picture you're seeing there, I've drawn you the bond price as on top and comparing with the S&P 500 in the bottom. And if you can see, I left a period or a column in white because that was the period when QE or stimulus was being thrown into the equation to try to pump prime the US economy. And it did work during that particular time. Now that they started to be able to unwind it, if you noticed, when the beginning of the year, people were wondering, oh, since they're going to be taking bond buying out, would that soften the market? In fact, if you were to look what happened, it actually strengthened the US market. And that's what I was trying to insinuate when I last showed you this particular graph, that it could actually even enforce the advance in the US, because yes, it might be taking stimulus out because it is recognizing that the economic recovery is actually good enough to stand on its own. And I think that is a much more longer term complement to that particular trend of activity. Furthermore, just to be able to substantiate that a downplay on interest rate fears, at least in the global context, came to be, if you look at that chart that you see there, that is a chart of a 10-year yield in the bond market in the United States. And if you see, the most recent activity has actually still been downward in its call, and so that means that despite what you've been hearing, it looks like interest rate prognosis is still going to remain rather subdued. Even if it does manage to be able to make a rally, perhaps it will be contained within a consolidation, and doesn't seem to be preparing us for something big and immediate in terms of the time frame. In fact, in Europe, instead of keeping things sideways, as many people expected, the ECB actually lowered rates, as April pointed out earlier on, and that also contributed to the fact that we've had the ability for rates to be, like I said, they're not so upwardly interesting. And hopefully that should be able to give more time for the allowances of many other economies that are relatively weak to try to be able to recover, given that the stimulant of lower interest rates still manage itself quite well. Now, going into Europe, now I'm a little bit more defensive in this particular market because I can see some structural weakness in the technicals. And if there's going to be any particular things that may be able to drag other markets down, it could be this one. Currently, the European indices, particularly the DAX and the French CAC, has already fallen back down to the lower end of the channels, as you see in the picture in front of you, and they are testing critical levels of support. And such that we have to be very, very watchful of what these things can actually pull down off, because if they do, then the tendency for this is to be able to break that trend line and generate a much more longer term consolidation. That could put a dampener, at least from that perspective, and may drive some other markets down along with it. In terms of a welcome surprise, recently we've seen some very, very strong showings in Hong Kong and in China markets. They've been quite subdued in the early part of the year, but in recent weeks we've seen very strong uplifting movements in the Hang Seng, which has actually just broken off the 24,100 level, and that pushes it to almost a new 2-year high, whereas China's also been recovering quite well. If you notice the graph on the right side, a major downtrend line has actually been broken, and that also is very stimulating to be able to profess that a potential reversal condition could be coming around soon. Although it still has to be able to deal with a big consolidation band, but I think the groundworks for an eventual revival in demand may be upcoming, and that could be telling us that perhaps the economic crunch that has been taking place into these two particular markets may be coming gradually into an end, and markets are already starting to be quite sensitive to that, and that could be quite favorable again to the Asian markets. Now, in terms of other markets in Asia, and just to be able to show you that the bullishness into the particular region is still quite very strong. The 6 graphs that you see in front of you, Japan, Thailand, Singapore, Indonesia, Malaysia, and India, all of which are still showing clear upward trending markets. Some of them are a little bit overbought, yes, and that could also introduce some pullbacks in price into the short term. In fact, I would be expecting that from countries like perhaps Thailand, Singapore, perhaps a little bit from Indonesia, and maybe a little bit of Japan when it hits such overbought readings as well. But I don't really expect too heavy declines of that, because perhaps we'll be looking at pullbacks only to their trend lines, and such support pullbacks are going to be new opportunities for people to be able to buy into. In terms of currencies, let's focus on the euro and the dollar. The euro has come into a recent low in 2014. I would presume that the lowering interest rates had a very heavy hand to do because, of course, that not only tells you that the return on the currency is actually dropped, but, of course, lowering interest rates is a clear measure telling you that the economic revival is not too strong yet and they need more pump priming. And so that means that more defensive action may likely take place. You can also see a major uptrend line had been broken recently in the euro, and so that doesn't really paint too much of a good picture. And that should be able to qualify perhaps the euro coming closer to maybe about 130, maybe even 127 if things go very, very weakly. In terms of the US dollar, I think we do continue to see strong showings in the dollar, although, yes, there is a wide consolidation range for the dollar. The dollar index have actually recovered quite well. It's made a higher low and even broken a recent high in the short term. And that also still suggests that the dollar could recover a little bit more. And since this is also a good perspective, being the inverse of that euro index that you see on the left side, if the euro continues its trend to be able to weaken, then that should be able to give the dollar more incentive to be able to strengthen. So we might be able to see more strong movements into the dollar into the short term. In terms of commodity prices, last I met you, I was not too favorable so far into commodity prices, as downtrends were still quite in place. Recently, we've seen some recoveries into commodity prices, which had led to what seems to be a basing out process, which is the first movement that you'd like to see before prices manage to be able to make more significant recovery. And perhaps this could be highlighting, particularly for industrial metals, that there is some sort of signal on a revival in terms of global demand for such industrial metals. And in terms of precious metals like gold, silver, and platinum, this comes also in consequence because we've had some volatility into currencies, and perhaps staying into precious metals might have taken the limelight when, of course, that we've seen some volatility into the dollar. But as the dollar continues to stay strong, I think many of the precious metals might just consolidate in a wide range. We would need these ones to be able to break through major resistance points to be able to convince us that more revival power is going to be included. But at least as so far it seems that the worst is over in terms of the declines for copper, for gold, silver, and platinum. In terms of oil prices, we still see an upward bias in terms of the trends, although we've had a very, very sudden streak not too long ago because we've had some pressures from the Middle East and, of course, the European crisis that we've also been closely monitoring, and that has forced a short-term upward press into prices so far, with oil prices per barrel coming almost to $107 per barrel. I think it should try to be able to weigh down a little bit and maybe produce a trading range somewhere between maybe 97 to about maybe 103 in terms of it to stabilize. All right, so now let's turn over a little bit to the Philippines, and let's try to be able to see whether the market is being influenced from some cutback in GDP growth, and whether we could see that prices can be a bit more sustainable, of course, moving up to next year. In terms of the Philippine Stock Exchange Index, the weekly graph you see in front of you does present still solid movements. We still see a short-term advance into a channel which has not yet been broken. And as such, that we have recently hit a high of 7,000 in the index not too long ago, but we have seen the index manage to be able to water itself down after reaching such overbought levels. And what's quite unfortunate is momentum signals have actually been slowing down. If you notice, the MACD reading we have here on the right side is already starting to be able to pull down. And when you get readings like that into a weekly perspective, that is trying to tell you already that there is a little heftier selling capacity being introduced into the market. So that clearly is something we're going to have to reckon with into the short term. I would expect that the index may be able to build a range between maybe in support of 6.7 to about 6.5 for the onset, and keep itself first with a high of 7,000, and perhaps try to wind up within that range to try to be able to find some footing. We'd also like to be able to note that even there may be a chance that the market might even bounce a little bit, but like I said, with MACD readings like this and momentum readings that are so feeble, I do not expect it to be too lasting. So when you see any rushes in price activity, it might be a good time for you to take some profits first and allow yourself to be able to buy back when prices stage some reactions. All right. I guess one of the biggest questions I've been bombarded with is everybody always asks me the same question. Where are we on the Elliott wave? Now, last time we spoke, I gave you my pronouncement that I feel that we are still in wave 4. In a bullish mode, usually there are 5 waves moving upward, and wave 4 is a corrective wave. And that corrective wave was very clear about the consolidation that we've had. So if you look at this particular picture, we're looking at somewhere in this range here. Hopefully, we're at about this caliber here, but we can only prove that once it's broken off the top of that previous high. But so far, we haven't done that, so it's very difficult for us to be able to confirm that we are even in a wave 5. So as confirmation is lacking, we stay pegged on wave 4 until we can give clear signals to the contrary. Now, in terms of the index and how I place my count into that, the image on the right will show you how I've managed to be able to count the Elliott wave. So here's wave 1, wave 2, wave 3, wave 4, and we're having a bounce right now. And corrective waves can be divided into 3 sub-conditions. And usually when markets do make corrections, this is the kind of correction that you might usually see when you see a corrective phase. So it doesn't just pull back once and then it rushes right away. Usually it pulls back, makes an interim recovery, then makes what is known as a C wave, and that C wave completes the nature of a corrective wave, and then we can see a much more substantial revival in terms of prices. Now, I don't think we've seen that C wave yet, and that could fall quite in sync with our expectation that we might see the market pull back into the short term and generate that second leg of support testing that is required before markets manage to be able to revive itself. So, being said, however, I think what's important to see here is that you can see that the long-term uptrend line is very much intact, although prices right now are a little lofty from where that blue line is of support, and that's why it would do for the market to be able to show a little bit of a pullback to necessitate the presence of support and justify buying when risk-reward is a little bit more attractive. Now, I'd like to also continue a sample that I showed you earlier in the year when we last spoke. And I presented a particular model for you, which I saw way back in 2005, 2006. And it seemed that markets seemed to be trying to be able to simulate that all over again. So I would just like to highlight it and give you a progress report into what we were expecting. So last time we spoke to you, our market, if you see the Philippine index here on the right side, this is where the index was the last time we spoke to you in early February. And I was telling you that time that this looked quite similar to what was happening there, and I was telling you that this is a possibility for the market to be able to show. And if I may just to show you what our market did, and so far, the template seems to be working quite well. Now, if you were to be able to put this in perspective of what happened over here, we're somewhere over here trying to instigate this little corrective element, and that's what attempts to be able to feed our perspective that a reaction or a pullback may be very much into place and something we're going to have to be able to build in. So a winding process is necessary. You cannot climb up from that low of 5,700 to 7,000 and not have some sort of adjustment to be able to build in. Moreover, if you factor what fundamental capacities are looking at in the short term, it might be in good justification to expect that reaction, allow prices to pull back, allow valuations to become a little bit better and prospective in terms of risk-reward in order for us to be able to deliver a buyback. And just to be able to show you another historical sample, I pulled out a historical graph of the United States and Thailand, and I wanted to point out that these were consolidation activities. And similar, we've had a punch out of those consolidation activities. And you can see that it's rallied first, and look at the consolidation that came thereafter. And so, I sure hope that it would not take as long as what we've seen during that particular period. But if you also notice, it also seemed to be coinciding with a bottoming out of interest rates, which is something that we've also been looking into. And so perhaps that the bottoming out of rates may force on people to be able to realign their perspectives and see how it would affect certain industries, and whether it be doing so harshly or would it be doing mildly to be able to convince them to be able to get back. So we do have to be able to prepare for that there is a possibility that we could see a winding movement in markets for the meantime. And do remember that in that graph I'm showing you, that was about 2005 for both cents. And remember, markets still went all the way to new highs, all the way up to 2007. So the continuing story of that consolidation is that it punched above it and it continued to be able to move into the next high point. In terms of the Philippine peso, I think the Philippine peso seems to be doing quite well. We've had prices swing closer to about 43.30 already in recent days. And do mind you that the peso is becoming stronger, staying strong, even if the US dollar is becoming stronger. And so if you were to look at that perspective, that means that the Philippine currency seems to be holding its ground quite well. And that could also support the fact that I don't think that you'd probably see too much capital flows outside as long as the currency remains stable at best, or even possibly that even keep its strengthening motions come up. So I would expect the peso to stay within the range of maybe about 43, maybe to about 42.70 into the short term. Just to highlight the sense of weakness where we're seeing in our markets, so here are the sub-indices, and if you can see, I've put out all the 6 subsectors inside. The weakest of the 3 are in the bottom. So you can see the property, the financials, and the holdings companies. And this is very much in line with what April was talking about. And given that they are structurally weak, I would expect more weakness to extol itself from these sectors rather than the first. The mining is colored in blue, and that means I'm a bit neutral with that because it could enter also a consolidation phase where right now services and commercial seem to be the leader of the pack. So in terms of our tactical position, I think it's important to be able to understand that prudence is really the better part of valor right now. We don't want to be too aggressive as consolidations come in. Maybe we can look to take some profits in some of the issues that have already hit their targets or are already showing some degree of momentum loss, and wait for prices to be able to react from that. So waiting for support is essential. We don't want to be able to be paying too much right now when you have what is known as a weak bullish market from this perspective. So wait for these things to come down. We want to be able to improve our ability to make money. So that's why, of course, pulling back down to support is what we want to be able to keep our eyes pegged on. And that should improve your conviction and making that trade once you see prices head there. And during this period, you will have to be able to understand that the trading strategy would be range trading. And that means you would be buying as prices come closer to support. Of a rebound, you will be looking at to sell it when it comes into the next level of resistance. And you don't have to be too aggressive. You have to be able to make sure that you gradually buy this when the support levels come in. All right, so April gave you a list of stock picks that we've had, and I just simply outlined some of the support figures and resistance figures for you, so you can use this as your particular guide. But I will go through some of those issues just to be able to give you a sense of what those particular companies look like. There are companies outside of that list that look technically viable, but I will be discussing many of those in technical spotlight, so many of you please do review much of our publishing so that you can get a clear vantage point on those. So just very quickly, I want to be able to point out in graphic form the charts that the stocks April pointed out. Ayala Corporation still remaining quite strong. So what your technique will be over here is quite simple. I drew the consolidation bands for you. You should be looking to buy closer to the blue lines and not be buying closer to the red lines. Right? I know drawing those lines might not look as simple as it is, but that is the better place for you to be able to look to pick up some shares. If you look at Ayala Land, also into a consolidation. So again, try to be able to buy it closer to where support is much stronger, and looking to take some profits closer to where resistance is very much present. You will all get a copy of this report already, and you can download it from our website tomorrow, so you can have a much more detailed look. Aboitiz Power is also into a consolidation band, so if you're looking for better prices, you should be closer to this price and looking to be able to sell it closer to about the high range of that range you have there, which is closer to about 38 pesos. Banco de Oro, well, I'm a little bit wary about this stock because I think this one has room to be able to pull down. It's currently threatening support, and if it does break, then we might be able to see the price come back down closer to here. So please just wait for the next support level before looking to pick it up. One of the stronger issues that we've seen recently is DNL. But if you can see from the graph I'm showing to you right now, DNL's on the upper side of the range. So we want to be a bit more defensive here and maybe look to be able to take some profits. I'll be looking to be able to buy in much more aggressiveness when it comes back down to the trend line. In terms of EEI, which is also mentioned by April, it seems to have just recently managed to pull off its support, so that might have given a timely movement. But again, we've seen 2 days of an up move, and I guess we want to be buying closer to this and not in the middle ground and clearly not in the higher ground there. So always buy it on the lower end. In terms of Metrobank and MegaWorld, if you've seen Metrobank manage to be able to break below its uptrend line, and that means that we'd have to be able to see support closer maybe to 284 pesos. So again, we'll also have to be very defensive there. And I guess one of the very clear weaknesses we've seen in markets recently was MegaWorld. And of course, we've seen 2 tops being made, cracking from a consolidation band, and that breaking through key moving averages. These are all very clear indications that we have to back off and wait for a new reversal prospect to come in. And I would expect that the next level could be closer to this lower band, which is closer to 4 pesos per share. And the final 2, SM Prime and PLDT. And if you can see, SM Prime has been heading into a reactive channel, so I'm not a very big fan of buying stocks into a downtrend, so I would clearly wait for this to be able to go back to the next support and hopefully generate first a reversal signal before even attempting to get myself involved there. The second chart, however, PLDT is one of the stronger stocks, and it also is coming closer to the higher end of its range. So perhaps buying should stop here, look more to take your profits as prices hopefully can pull up a little bit more, and then look to buy back when prices come lower to the lower end of the range. So in terms of the summary of that, we've seen that global markets have shown several bits and pieces of strength and weakness, and I would expect rotation to be able to continue towards the second half of the year. And we would have to be able to build in potential corrections to many markets that have been quite exaggerated. And this should present more volatility and I guess should be much more active for those who are short-term in nature because, of course, traders would be a bit more crafty in being able to pick out those opportunities. The PSEI is clearly a working candidate to correct. And now, as you can see, that momentum is also starting to be able to soften up. Then there is a clear estimate that we could see easily a pullback to 6,700 and perhaps to 6,500. And we also want to be able to draw out that a consolidation would come through this. So don't think that the rebounds will be pushing to new highs anytime soon. You will see a cascade that will go sideways for the meanwhile. So just be prepared for that. So cap down on aggression and wait for pullbacks to support. And I guess that will be the call out that we'll have for the meantime. And I hope that when I speak to you again at the beginning of next year, that we could show much more incentive to be able to work up a broader list of stocks to be able to take advantage of. And finally, that these corrections, remember, are necessary. And as these corrections are more necessary, it will be opening up the next opportunity that many of us have been waiting for. It's hard to buy prices when they're roughly elevated because your upsides are limited. But of course, it's corrections that would rekindle the ability for us to see better opportunities. And I think you'd probably see that within the third quarter. So keep alert and make sure that your ability to take these particular swings are very much in hand. So with that, I conclude my talk today. And again, I'd leave you with a words of Napoleon Hill, which says that patience, persistence, and perspiration make an unbeatable combination for success. So with that, again, thank you very much and have a good evening.
Thank you, Juanis. So to summarize, I'll try my best to summarize Juanis' presentation. So global markets to rotate. Philippines is a strong candidate for a corrective or consolidative action. And finally, patience is the key. Wait for the proper setups and be patient before getting into the market on a timing basis. Now, before I move on to our chairman's words, I would once again like to remind everyone, if you have any questions, you can text us at the number flashed on the screen, and you can also tweet us at COL Financial using the hashtag AskCOL.